Buongiorno.
Good morning. Good morning, everybody. Good morning and welcome to this meeting with the Quality Growth Boutique. It's a pleasure to see so many of you. The Quality Growth Boutique is the one that made Vontobel famous in Italy. Today, I'm particularly happy to have here an exceptional speaker, Matteo Benkendorf. He is the CIO of Quality Growth, and he's been with us since 1999, 18 years with Vontobel. In addition to being CIO, he's also lead portfolio manager of the most famous strategies, global equity, emerging market, and USA equity. With Matt, today we'll tackle some hot topics, i.e. the market outlook. So what's the risk in the market at present for investors, and also we'll see how our quality growth strategy is actually responding to these needs and meeting the needs posed by this type of market. It's in fact a strategy that really is suitable for any type of market. We will also provide you with an update on all the portfolios and strategies that are managed from New York. Let me stress 4 pivotal points in the quality growth strategy, namely what we mean by quality growth. So, number 1, we invest in those companies and firms whose earnings are steadily growing, so that we can forecast growing earnings, growing corporate earnings year after year, because this is really functional to ROI. So the most important thing is compounding the growth of these earnings. It's extremely important that. Second thing, we don't want to overpay for these quality companies. We want to buy quality companies, but we don't want to overpay. And we'll tell you what we mean by a fair or reasonable price at which we can buy these companies. Why do we want to do this? Because history proved that this strategy allows us to create an excess return over the market while lowering risk and volatility. I'd like to share with you some in-house studies. First of all, I'd like to show to you this strategy. This is global equity. It's the retail asset class. There is no single investor who invested in the global equity retail asset class who bought this strategy and has retained a position who is not making money. So Matt, thank you a lot. You do deserve a big applause for this, because all who invested in this strategy are really in the black and making money. Here you can see the performance of the fund compared to the benchmark, the MSCI World. Be careful though, we are talking about equity investment. So the very first job for you investors is finding a capable, a good, active manager, and we do have one. And the second thing is actually benefiting from time. You have to explain your clients that their best ally for equity investments is time. Warren Buffett said that when you think you want to buy a stock, you think you want to hold it in your portfolio for less than 10 years, don't even buy it for 10 minutes. So this is the same approach we have decided to stick to. So remember that all the investors who stayed invested are enjoying a positive return. Let's see how returns or how the fund would have performed over a 1-year time horizon. Here you see the distribution of returns, a 1-year rolling period since the inception of the fund. So we have 622 rolling periods of 1 year. So you see, it over 1 or 2 years, it's not working. You still have a positive distribution for returns, but there are people who may have been extremely unlucky. Think of those who invested in July 2007 and had to navigate 2008. So when you invest in equities, you don't do it for 1 year, but take a look over the long or longer horizon. 5 years, for instance, and already you can see that out of 413 data points, there is only one that is really tough lucky. There is only one person who's got tough luck, really. And all the rest, you can see that the curves normalize and are extremely attractive. This is the distribution of returns. As you can see, 70, 80, 90% returns. This accounts for the kind of returns enjoyed by investors. So this is crucial when we think of equity investment. So we often quote Warren Buffett. So let me add another quote. The stock market is a device for transferring money from the impatient to the patient. So time is your best friend, second only to the choice of the best manager. Matt, please join me here because you are that manager.
Okay. Thank you, everybody, for coming. This is my greatest challenge right now, speaking slowly. So get ready. As those of you who have seen me before, once I get going, we're very passionate about what we do, but I'm going to try very, very hard today to speak very, very slowly to make sure that the whole message comes across. What we're going to talk about today is a bit about risk. And risk is an important topic. But what we're going to do is we're going to talk a little bit about risk in the context of how we invest. Because risk, what is risk? And I'm not here to have a big philosophical debate about risk, but what is risk? Is risk beta? Is it volatility? Is risk looking different than the index? Because those are all the conventional views of risk that most people would throw out if I asked you, what is risk? Most people would say something to that degree, looking different from the benchmark, et cetera. But to us, risk is the possibility of a bad outcome. That's risk to us. Not beta, not volatility, not looking different from the index. Risk is very, very fundamental. And that's how we end up with the types of returns that Matteo talked about to open the presentation. Not with this view of risk from a quantitative standpoint, but with a view of risk from a very, very common sense approach. The risk of a bad outcome, fundamental, how do we minimize the risks of these bad outcomes? And that's what we're going to talk about today. So let's first talk a little bit about what's going on in the world. First, risk is not visible in performance numbers either, right? We looked at some really great performance numbers, but let's just remember that too as well. As Matteo pointed out, the short and long-term performance numbers, and we're going to look again a little bit more at those. Let's also understand that risk is not in those short-term performance numbers. You could either be very risky or very low risk, but that will never be picked up in the shorter-term performance numbers. So you have to dig a little bit more deeply into the portfolio and into the philosophy to understand where the real risk control is going on. So let's talk about risk control in the portfolio for us at Quality Growth. Number one, protect capital. Risk control. Protect capital, number one. Number two, grow it, but grow it with sensible earnings growth. What's sensible? Visible earnings growth. Not a prediction of what could happen that isn't happening already, but look at a great business that already is a great business, that is already growing. How is it growing? And how the way it grows is very predictable. Does it sell you something that you consume and then you need to buy it again? Is it selling or doing something that's in extremely high visible demand because there's not many people doing it and a lot more people will be doing it, that's sensible earnings growth. Number 3, don't sacrifice number 1 to get number 2 over the short term. And we're going to talk about that. This is where people get in trouble. Number 1, people generally agree, protect capital. Number 2, then they try to find sensible earnings growth. But the problem comes in number 3, when you sacrifice number 1 to get number 2. And that's where we clearly stand out. And we're going to talk about how we do that. The next point, quality growth earnings are intentionally more stable than the cyclical benchmark. The important word is intentionally. It's a very disciplined style to find earnings, as I've talked about, that are more stable than what the alternative investors can buy, a much more cyclical benchmark that is unpredictable. Number 2, as I said then, the fundamental risks do not show up in the performance figures. Number 3, as Matteo led with the great quote from Buffett, consistency is the foundation to long-term delivery. Consistency. That's the value we bring. We have a very common sense approach. We have very common sense principles. We have a very common sense investment process. What we have to do is do it consistently, no matter how difficult or how foolish you can look in the short term. That consistency will make you look bad, but you have to continue to be consistent. And next, now we'll get into the environment. Risk is always there, I would argue. The only thing that changes in the market is the perception of that risk. If we think about what's going on today, there's generally nothing new. The more life changes, the more it stays the same. Interest rate risk, inflation risk, geopolitical risk, trade risk, bad politicians, good politicians. All these risks are always there in investing, and they're actually always there in rather similar degrees. The thing that just changes over time is the market's perception of those risks, the market's willingness to acknowledge those risks. That's the only thing that changes, and that's why it's important to stay fundamental, because you can't predict when the market will change its view of the risk that's been there and now it's concerned about the risk. So you better focus on the companies that can be strong and deliver good earnings growth despite the market's perception of the risk around those businesses. And that's the key to the last point, sticking with stable and predictable growth to underwrite the long-term return. So let's talk about where we are right now, and then we'll drive it into the portfolio. So number 1, no inflation visibly there, now returning. Number 2, inflation heating up in particular areas, the US, Germany, India. Oil getting stronger, right? Lifting the export markets. Consumer inflation not yet registering, but I'll show you how it's already still there. Rising rates in the US, likely to spread at some point. It's going to be very hard, I think, for the US to continue to raise interest rates without any follow-on elsewhere. It can happen for a while, but eventually you'll have to have a follow-on, and you will get it more earlier in emerging markets, but then it will follow. What happens when rates rise? Market perception changes of risk. Fund flows move. Fund flows leave equity. Fund flows leave low-quality bonds. How do you need to be protected? You need businesses that are attractive, that deliver durable capital protection and earnings growth, even when those fund flows materialize. First, foremost, where it starts to manifest is in frontier markets, where there's been easier takers of easy credit for a while. Next, U.S. trade balance reset going on, right? Trade balance reset between China, Asia, even Europe, Germany. Next, pricing power, right? Pricing power matters in inflationary periods. This is a key principle we've always had, but this is now what people are starting to realize. Inflation is there. Inflation, perception of inflation comes and goes. The way you handle it successfully as a business is with real pricing power. But what's turning the corner now, what's changing is now you'll start to see who has pricing power and who doesn't. The businesses who have it and don't have it haven't changed. Now you'll just start to see who has it and who doesn't have it. And then clearly there still will be this focus, clear focus on emerging markets and emerging markets growth and this long-term story there, right? But now the market actually will look a little bit more because of the trade issues in terms of where's the growth locally versus where is this growth come just by an easy global trade environment. So let's look at some of the current environment right now in terms of these risks manifesting, right? So current account deficits, double deficits, these are now back in focus. These have been there, right? The current account deficit and fiscal budget balances. Turkey, right? These issues have been there, but now you see the volatility in Turkey. Argentina was bad on a road to recovery. Now the market's fearful again. IMF's back in there, but why it's having troubles have been there, right? That's been there. Nothing has changed. These twin deficit issues, but now, to my point, people are starting to care about them again, but they've been there. What happens when you have these issues? You see exchange rate volatility, as we've had. When you run twin deficits, as you've seen in Argentina, as you're seeing in Turkey, you're seeing in Brazil, you get exchange rate movement on the back of it, right? That's nothing new. This is something that's been there, but now you're starting to see it. The frontier markets that I've talked about, this is often, as they say, where the canary is, where you start to see things get stressed first. The frontier markets and emerging markets often are the last recipient of the easy money. Everybody gets comfortable first with the developed markets, and then more developed markets, and then emerging markets, and then eventually you get out into the frontier markets. They're often late to the party and then first to leave. So here you start to see where do you see it? You see more than 40%, 45% of these low-income countries are at high risk already, high risk of distress, right? That's been going on, but now people's perception of it starts to awaken a bit. Public debt high, where public debt is high and public debt is in a foreign currency, still the same issue of the same historic risks. That's where there's vulnerability. And now the perception of that is picking up. The key numbers everybody's looking at, right? Inflation, to my points. Inflation has been picking up, right? Everybody focuses on the headline, though, and we're going to look at something a little bit more important. But obviously, inflation has picked up in the U.S., driving the interest rate cycle, right? Inflation picked up and getting stronger. What's going on? Wage growth, right? For several years now, running strong in the U.S. The pressures are building. The labor market's getting tighter and tighter in the U.S., right? Now we're awakening to that slowly, the awakening to the reality of that risk. But here is a slide that you don't see a lot. And my point about how the risk has been there. There's two pieces of inflation. There's services inflation and there's goods inflation. Everybody focuses on this slide generally in the US, you know, the CPI, the aggregate inflation. But there's two components of it, services and goods. The US economy is 3/4 of a service economy, right? For several years, services inflation has been running above the Fed target on that metric, above 2%, well above 2%. We're going back now, 6 years running. What has been weak is goods inflation, where everybody's a little bit more focused, but now you got both. Now you have both, and that's where the risk is starting to increase. And this is important because this shows you what people have felt for a while in the US and in other economies. People feel like there's been inflation. They feel like life has gotten more expensive. But when everybody looks at the CPI, they weren't seeing it there because the CPI was focusing too much on the deflationary aspect of goods. But we all consume and use services heavily. as an economy. As economies develop, particularly a developed market like the US, services are a very big component of your daily living and your daily expenditure. And this has been running hot for a while, despite very easy monetary policy. So now you get both. So my point again with what I've showed you is that these things have been going on. Just the perception of them is now changing and the awakening that they've been going on. Oil price, obviously, very front and foremost. One by one, all these metrics. And now US interest rates finally chasing them, right? So now let's get to the heart of the presentation now. So what does all that mean? So I've just reawakened you a bit to the reality of what's been going on. And that's my only point there with risk. The risks have been there, as I showed you in some. Just the perception now is changing. But just because perception is changing, we don't change what we do. We just need to continue to keep doing exactly what we've been doing during those periods where the risks were there and people didn't perceive them. And now when they start to perceive them more, we continue to do the same exact things. And how do we do that? Understand what we own, number one. So our basic principles, and Matteo outlined some of these. We run concentrated portfolios, own fewer of the best businesses. What businesses are we going to own? High quality businesses, high economic returns, good growth, visible, predictable growth at very sensible prices. Benchmark unconstrained. We're not going to look at the benchmark as our guide of what we should own. But that's how the whole world thinks. That's how the whole investment paradigm is built. The index, look at the index, if it's the US, if it's Europe, if it's emerging, if it's global. The whole focus is on the index. The index, why? Why is the index what you should own? Certain indexes are market cap weighted, so they're pro-cyclical. The more valuations rise, the more weight grows the index, the more you're forced to own. We break free of that psychologically. We say you want to invest in the US as a geography or emerging markets as a geography or globally as a geography. We're not going to look at the index. We're going to look for the best businesses that you can own there as our foundation. And the last point, as Matteo pointed out as well, is the critical point, long-term focus. Take the money from the inpatient and give it to the patient. So how do we carry this out and how do we manage the risks on a constant basis? Number one, companies, balance sheet strength. Number one, very basic principles, but strong balance sheets. These are credit ratings, so I'm going to use just a couple quick snapshots to show you these principles. But here's balance sheet strength. So here's our global strategy. I just pulled one strategy. Here's the percentage of our holdings across certain credit ratings, right? Typically, our businesses aren't levered to begin with, but very strong credit rating. This is by weight, but let's look at by number of companies, too, where things stick out even further, right? The first one was by weight, so larger companies with better credit ratings will be a little bit overrepresented in the index, and that's what the index does. It overrepresents sometimes the wrong companies. But here, if you look at number of companies even, the difference starts to get much wider. So own companies with strong balance sheets. It's that simple. What else do you want to do? Own predictable businesses. What am I showing you here? Two businesses. One's a home builder. One's Coca-Cola. The one line is predictions at point in times of what earnings would be. The darker line is what actually happened. If you own predictable businesses, what's predictable more often happens. Own better businesses, and then you don't need magic, right? You don't need a lot of magic. You just need common sense. More predictable businesses, things happen as predicted. So strong balance sheets we've talked about so far, predictable businesses. If you own predictable businesses with strong balance sheets, you end up with less earnings volatility. Why? Because volatility is caused by realized not meeting expectations, right? That's where volatility comes from. an expectation, and then reality having to move to match that expectation. That's what volatility is. And that's what the market is. It's an expectation. It's a forward-looking expectation always. And companies, at the company level, there's a forward-looking expectation. So the volatility is caused when reality doesn't match that expectation. So own strong balance sheets, more predictable companies, you get a more predictable portfolio with less earnings volatility in it. Back to our earlier principles. And this works everywhere. It works in the US. It works in emerging markets. You don't need a different approach. You don't need a different mindset, a different strategy. Same strategy, strong balance sheets, more predictable companies. It works in emerging markets. It works in the US. It works in Europe. What else do you need? Earnings growth. Right? Everybody focuses very closely on multiples. What are you paying? Is it cheap? Everybody in life wants something cheap. Right? But when you buy something cheap, you often get something cheap, right? If you want something good, that's we believe in life, you often have to pay for it. It's the same with a jacket, with a car, and with a company. If you want a great company, you have to pay for it. But that doesn't mean you can't create great value. As the old saying goes, price is what you pay, value is what you get. By owning something great with a strong balance sheet, predictable earnings growth, you get less volatility and good returns. That's great. That's your value. Your value wasn't in the cheap PE. It was in reality meeting expectations. Now this, I'm teasing you a little bit here in a backward way because this is Essilor. Those of you who follow the news, this will be your Luxottica, right? Luxottica, one of the great Italian businesses, is now merging with Essilor. It's imminent as we speak. And what I'm showing you here is the total return broken down. Why my point about what you pay is secondary to the quality of the business, right? This is the 15-year average shareholder return of Essilor. What's key is the bottom, right? Going in, you paid a high multiple, 25 times earnings. You didn't have to pay 10 or 15 or 18 and try to sell at 25 or 30. You paid a high multiple. The multiple compressed over time, and after 15 years ends up back where it was over the long term. But even if it did compress, you still compounded at a very high rate of return. This is to illustrate that point that everybody gets so focused on the multiple. What am I paying? Is it low? It has to be low. Otherwise, I don't get any value. That's wrong. Buy a great business. Get the earnings growth right of a business that sells something that's predictable. What's predictable? Eyeglasses. Dominate the market globally. Have a market share 3 times your next competitor. Have a product where there's innovation naturally. What's innovation? Protective coatings, no scratch. Tinting when the sun's out. No fogging when you walk into a human environment. This isn't crazy. You don't have to invent a self-driving car, a flying car, a rocket that goes to the moon. You just need glasses that don't scratch. But that's innovation, and that's something you'll pay for. How many pairs of glasses do you own? Several. Why? You lose them. You break them. You have them. You need to buy them. Why? What's great about glasses? Your eyes change over time. Last year isn't the same as 2 years from now. You need new ones. Predictable. Not crazy, not magic, predictable. Get the earnings growth right, get the predictability right, and you get a tremendous amount of value. Assemble a group of businesses like that in a portfolio, and this is what you get when you have a bunch of those businesses together. Not just less volatility, consistent earnings growth, even in the financial crisis, 2008. Matteo showed the slide. You know, in 2008, stocks were under pressure, but our earnings grew. Great businesses still grew in the depth of the greatest crisis since the Great Depression in the United States, right? Still grew earnings through great businesses. Cumulative effect is extremely powerful. Buying and holding all these great businesses over a long period of time, right? So what have we talked about? Great balance sheet, predictable businesses, get you less volatile stocks, get you a less volatile portfolio. Get the businesses right at the stock level, great businesses, you get a great portfolio. And all those slides we started with at the risk, whether the market perceives them to be high or low, if they've been already there, it doesn't matter. This is what matters. Next slide, ESG, right? It's a part of the process. We don't lead with it. We don't say we want to go out and buy businesses that are great on these metrics because this is what gets you great returns. We want to buy really great businesses that are very predictable, very sustainable in what they do. And when you look for those businesses, you often cross these paths, right? So we don't think ESG should be something you go out and search for. You should search for great businesses. And you should just make sure what makes that business great. Understand whether it's the earnings drivers or it's the management and governance. It's how they handle regulation. Do they destroy their stakeholders? So these are our principles. You know, the goal of businesses, we think, is to profitably serve and develop demand long term. Profitably, that's the goal. When we look at our businesses, that should be their goal. Profitably serve and develop demand over the long term. Number two, though, sustainability of that effort to generate profits means you have to balance. You have to balance your stakeholders, your shareholders, your employees, your customers, your community. But look for the great business, right? Without profits, there is no business. Without sustainable, durable profits, there is no business, right? So in your effort of finding these great businesses, you just follow these principles. And we recognize that there is risk then in a business that doesn't have strength in these ESGR principles. That can boost things over the short term. You can sacrifice quality, you can sacrifice your stakeholders over the short term, but that's going to cost you over the long term. So just keep that in mind from a common sense perspective. So we do focus on this, but within the investment process. It has to be within the investment process in the search of a great business, making sure what's part of a great business are these elements. Now, the number one thing we focus on is governance. Number one. This is the most important part of ESGR, governance. Who's running the business? How is the business run? Is the board adding value? Is there too much management change? That's what we spend a lot of fundamental time on, right? Then regulation. You know, how does this business interact with regulation? We tend to like businesses where regulation isn't a threat, it's a strength. Regulation is part of what makes that business strong. It's a protected monopoly. It's got barriers to entry built because of that regulation. Look at one of the biggest topics over the last 6 months, data privacy. Right? Data privacy, Facebook, Google. Let's talk about risk again. Is it new that they've been collecting all this data? Is it new that they've been using that data to monetize their customers? All of a sudden, the perception is there in the last 6 months. That's the only thing that's changed, right? It's always been there. It's been going, and it's going to keep going on. Just the perception is now changing. But my point here is on regulation. You have a new regulation in Europe, GDPR, right? Is that regulation going to weaken Facebook or Google? People might think so, but they're wrong. That regulation is going to strengthen them. That regulation just made the wall around their business higher. Because you tried to regulate a wall around the two strongest by miles, by kilometers businesses out there. That is a regulation that enhances a franchise at the end of the day. Why? Because smaller competitors can't handle it. It's an extremely onerous regulation. If you have size and scale and can handle it, you just built your barrier to entry. So that's how you want to look at businesses. Is the regulation a threat or is it a strength? And in this case, you just saw one that actually will end up strengthening these businesses versus competition, at least from a competitive standpoint. But that's where you want to make sure the governance is there, the regulation is there, and then you need to make sure that the management interacts properly and handles the regulatory challenges, right? Environmental and social. Now, this is where you get further down. It's funny, those of you who know our style, what we buy a lot of, what we don't buy a lot of, I can honestly tell you, environmental, when you evaluate a company, is it a great business what makes it so profitable. Environmental is at the bottom of the list generally. You need a business that isn't destroying its local environment. Why? Because that brings more regulation, that brings more scrutiny, that destroys profits, that hurts your stakeholders. But the one thing I'm telling you we honestly spend the least amount of time agonizing over, because it's very easily documented and researched, right, is where we score the highest. Because we don't own energy and commodities generally. The most extractive, environmentally unfriendly industries. But why don't we own them? Because we're looking for profitable businesses, sustainably profitable businesses. Not because we said we don't want to own them because they drill holes, they burn fuel. We just want sustainable, profitable businesses. But your search for that, number one, leads you away sometimes from what most people are trying to avoid. Social is the last piece. You know, as a lot of you know me too as well, or know our products and stand up here, social is the one thing we have a difficult time with. And we have a difficult time because social norms change over time. My job is to find our investors profitable investments to preserve and protect capital and compound capital that follow the proper principles of governance, rule of law, right? Be sustainable. Social is a little bit different and difficult, I think, just honestly because the social norms change. And what are social norms in some countries can vary to other countries. And what's a focus? So it's why we do, honestly and transparently, spend less time on that. We're willing to comply with certain client focus on this issue. But, you know, in the Nordic regions, the environment is a big social focus. It's unique to that, which often there's a lot of irony in it because it's taking place in a heavy oil-intensive area. In Australia, tobacco, you know, is a big social focus. In other countries, in the UK, gambling has become another social focus. So my point here is just, you don't want to lead with social, number one. You want to lead with profitable, sustainable businesses. But number two, be careful with social because the target moves over time. And the target is very different across countries and geographies and people. And I think you need to respect that. So our view has always been we're not going to impose our own social lens on certain areas and certain businesses. We'll let our clients or the geographies dictate that. If you do all of these things, strong balance sheets, more predictable earnings, portfolio of great businesses, all in aggregate, what do you get? Great returns, but critically, downside capture protection. That's the point here too, right? Whether it's in the global markets, whether it's in the US markets, whether it's in the emerging markets, this is what you're looking for. Capital preservation, downside capture protection. This is the power of math. But it's all born out of all these building blocks we've talked about so far, right? This approach. The math is simple. I always have to remind everybody. Let's do some basic child math again. If you're down 50%, you need 100% to get back to where you are. Basic compounding math and patience works in your favor if you protect incrementally on the downside. How do you protect incrementally on the downside? All of these building blocks that we've talked about to this point. And if you can do that, these are the types of returns you get over time. Not to spend too much time, but they're in your presentation to come back to. So now here, everything I talked about sounds great. So what's hard about it? I apologize, I took a picture of Matteo exercising this morning. It's a little embarrassing. I don't know what the tire is for, but everything I've talked about is common sense, but now I have to give you a little bit of reality. It's not that easy. What we do is easy in principle or easy in theory. It's a little bit more difficult in practice and application. That's the value we have to bring as investment managers. Because as this says, resiliency is the key. Being resilient and disciplined in what we do is key. And let me show you, because it looks and feels good, but there are times when, because we do what we do, we will underperform. But you have to be resilient in the process and approach. You cannot change your philosophy and approach. And this is the global equity strategy. And the lighter colored lines are longer periods of rolling out performance, similar to what Matteo showed you at the beginning. The longer you stretch out the time horizon, the better returns look. But the problem is, day to day, what we feel is the shorter term, right? This is only rolling 3 months window. So I even condensed it even further. This is what people feel day to day and month to month, right? This is what they feel. But in order to get the long-term returns, you have to feel that. That's the one thing we can't avoid. You have to feel that pain. But it's not really pain. It's not real. You feel it, but you're not losing money. Why? Because your companies aren't losing money. Your companies are growing. Your companies are resilient. But that underperformance is part of what you have to feel. And this is what happens. So, global financial crisis, we accumulate great relative outperformance. Markets start to rebound, right, off the bottoms. We massively underperform as markets start to rebound off the bottoms, right? And we give back some of that cumulative relative outperformance even to the low end. So we save up our relative outperformance like it's in a bank, right? We're always banking it relative long-term outperformance, accumulating capital for our shareholders. At certain points in time, the relative outperformance, we will have to give some back to be consistent with our approach, weather the short-term underperformance, but then things normalize and you continue. And here, over the last couple of years, we've started to feel a little bit of that pressure again. We felt it a little bit more, not so much in global or US, but in emerging markets, right? Emerging markets typically goes through stronger cycles of recovery. So the financial crisis is deeper, right? Deeper, so we outperform. Financial crisis hits, we perform better, right? But then on the recovery, we start to cede back some of that long-term outperformance. But then here we go. We start to produce, great outperformance. Emerging markets bottom in 2016. And since that recovery, we start to cede back some of that relative outperformance. But just like this, that will normalize, right? Once you get off the market bottom, that will normalize. But you have to feel that to get the long-term success. That's part of our pattern. Here's where it shows even more in these slides. Rolling 12-month, this is for our global product. Look at the rolling 12-month, right? Stretch out your time horizon, 36, 60, 120. Right? Everybody wants this, but not a lot of people want to take this. But you have to have this to get this. You cannot get this without that. That's the key message here. Why? Because you have to be style consistent with great, high-quality, predictable businesses, even when the market doesn't think you need those businesses. The market thinks you need to own more cyclical businesses or lower quality businesses or just cheaper businesses. That's going to always continue to happen, which will make this picture sometimes look like this. But without this, you will not get this. One of the key areas of what's causing that right now, staples. This is one of the biggest headwinds right now to near-term relative underperformance. Everybody, staples, why do you own staples? Staples are broken, this and that. This is why you own staples. Go back almost 15 years. The top line are our staples, the black line is our portfolio, and the blue line is the index, right? You own staples because you don't know when the financial crisis is going to hit. These are 3 different periods of drawdowns now over this period. You don't know when you'll hit a slowdown in economic growth and reported numbers and the market gets difficult. But in every single period, staples meaningfully outperform, meaningfully on the downside, positive when the market's negative, positive when the market's negative. This is where we face the greatest amount of questions right now and headwinds because the market is saying, buy self-driving cars, buy technology, buy energy. buy everything, don't buy staples. This is a reminder. In fact, the best question here isn't why you own staples. It's the great question, why don't you own even more staples? Right? You can see even as it outperforms the portfolio, but believe me, we own a considerable number of staples. Typically in the portfolio, as you know, it can range between now we're at the lower end of 20%, as high as 35, 40%, right? Why? Because they add a tremendous amount of value over the cycle. I think this is a very important reminder to people. So what are you owning, though, when you own staples? We're not owning something that's not growing, right? You need to own growth staples, though. People talk about staples right now not being attractive, but mostly what they're talking about are lower quality businesses. They're not talking about staples. The staples that aren't doing well are lower quality businesses. Their problem isn't that they're staples, it's that they have a lower quality business. And why do they have a lower quality business? They're not number one or number two in their brands or what they do. They're not in the right categories. They're not doing business in the right areas of food or make household personal care, right? And they're often not in the right geographies. So they haven't expanded over years into the right geographies. These are what make great businesses. It isn't about being staples. Be number one and two are what you do. Be in a good business of what you do and do it in a good place. That's the problem with the lower quality ones right now. Here's an example of what we do own. Couche-Tard in Canada. Why is it a good staple? It's a convenience store. Why is that good? Because Amazon doesn't disrupt their business. Right? The fragmentation, everything going on in retail, it's real. But the question is, are there businesses that are more resilient to it and that are unaffected by it? And convenience stores are one perfect example. So what we own is the largest convenience store operator in the world, but still operating at a very small market share versus the global end market. So they're dominant in what they do. They're in a good business. They're doing it globally in good markets, and they have plenty of room to continue to grow organically and via acquisition. So the economic returns are very high. High returns on invested capital historically. What happens with that? Earnings growth and stock price follow each other over long periods of time. So it's not about owning a staple, it's about owning a great business. A more predictable, more durable business that's less economically sensitive with great growth. Another one that's very high profile, right? Unilever. These great investments, they're in plain sight often, right? Unilever is a fantastic business. Great economic returns, 4 to 5% top line growth, cost savings to add margin expansion, right? Share buybacks, double-digit earnings growth, right? The stock price follows. Now, here's ironically, this is where the market was a bit, pessimistic on the names because they were weighed down. Earnings were weighed down by a number of reasons which weren't real, currency translation, things like that. So where you had to be patient and then the earnings growth comes back up and meets the stock return. So there are even great opportunities sometimes in names that hide in plain sight where you can take advantage of the market being too short-term focused. But here is a great business in number one and number two in everything they do, in the right categories and in the right geographies. Okay, the last point. Let's talk a little bit about the benchmark again to wrap up. Because everything's always benchmark, right? We want absolute returns, predictable returns, durable returns, but let's talk about the benchmark. This benchmark, everybody's always focused on keeping up with the herd, so to speak, but we think there's a couple things to remember. Look, and we equate it to racing, right? If you're so focused on the benchmark, you're just racing. And racing, as we say, is usually not the safest way to do anything, just racing at high speed, right? When you're racing, you're really never, to the second point, focused necessarily on the absolute returns. You're just worried about catching up or being faster, but you need to focus on absolute returns. We think you need patience and time, and those are absolutely required to get to compounding. You just can't race. You just can't be so focused on the benchmark as your race. You got to be focused on yourself. What you own, what it does. Is it delivering earnings growth? Is the portfolio giving you the characteristics you're looking for? Compounding, preserving capital. If you focus on that, you'll beat the benchmark. But you don't need to sit there and race the benchmark. As we say, scoring or performance measurement, that doesn't replace understanding. What do you own? Does it have a strong balance sheet? Is it predictable? What does it do? That's hidden. in the short-term numbers. And then on top of that, when we talked about ESG, you have to be an owner of a business too. So we buy great stocks, we buy great businesses. They do a great job over the long term, but you have to be an owner. You have to act like an owner too as well. And that's what we do on our investors' behalf. You have to review all your proxies. You have to vote all your proxies. You have to make sure that the governance standards are there. But that's just acting like an owner. That's not being ESGR. That's just acting like an owner of a business. So with all that being said, let's pull it all together. So what is prudent, as we say? Consider each company you're invested in. Understand, engage, and act like an owner. Invest with high conviction. Run portfolios with smaller number of businesses, but great businesses and high weightings. Be willing to accept lower returns when the markets are high. Don't chase. Recognize that valuation profits are tied, right? More loosely over the short term, but strongly over the long term. And remember that long term, those returns are driven by real cash, real profitability in businesses. Not, as we showed in Essilor, about P multiple expansion. Investing is not about buying something that's sitting on the ground for 50 cents and picking it up and selling it for $1 just because someone changes their mind about what it's worth. It's about getting the earnings growth right and worrying less about that P multiple in and out. So the last reminder of the principles of our approach: protect capital. Grow it in absolute terms with sensible earnings growth. As we said, number 3, don't sacrifice number 1 to get number 2. How do you handle risk? At the company level, you'll be enduring through the economic cycle, and take advantage of market structures, which are the index, right? Take advantage of that. And then the last point is about the resiliency that we showed you the slides on. Outperforming the benchmark over the long term is not the same as outperforming all the time. You have to underperform when you're style consistent in order to deliver the long-term outperformance. And that's what we all want. That's what we all eat. That's what our investors need. That's what our savers, individuals need. They need to outperform over the long term, not the short term, because that's what investing is. So realize that they're not the same thing. Over time is not the same as all the time. And in fact, not outperforming all the time is what allows you to outperform over the long term. And with that being said, thank you very much, and I'll be happy to take any questions.
I left. Yes, grazie. So you can stay there.
Okay.
On this
Wait,
side.
are you afraid of me?
Yeah.
Why are you way over there?
Because no, if you have to use some slide, I don't know. Allora, grazie mille intanto.
Well, thank you very much, Matt. Really excellent presentation, and thank you for your questions too. Let me just ask the first few we have collected. He switched to English.
Part of questions that are on the process.
Okay.
So, first question is about the monetary politics of the U.S. And I connect to the second one, that is, has it an impact on the future of the euros? So what the impact that can have monetary policy in the US, and if we have a view on the euros?
On Europe?
Yes.
Connection to Europe, okay. Yeah, well, number one, fundamentally, as we talked about too a little bit, but not so much here, we can't predict, we don't have predictions about where exactly monetary policy goes, when it goes there. All we do is have a natural realization of what current and existing risks are, and then how we minimize them in the investment approach. The way we do handle the unknown, though, and the inability to forecast, aside from just finding businesses that are more immune or resilient to the monetary cycle, is you just be conservative in your assumptions, right? Always be conservative. And one area that's baked in is in valuation, right? With the healthy realization that monetary policy has been and is normalizing, one piece we didn't talk about in here as much is high quality, predictable businesses, long-term holding period, look different from the benchmark. but as you pointed out in your earlier points, we're valuation sensitive. So valuation sensitivity comes into the best or one lever at how we handle the tighter monetary policy environment, and that's making sure we're exactly on top of our valuations of stocks. We've made conservative estimates in terms of how fast they will grow and how we discount the cash flows in those businesses. So we're using materially higher interest rates to discount the cash flows to allow room if interest rates continue to rise, that we're not behind, we're ahead of that. And then making sure we're always trimming and selling out of businesses when they reach, near, or exceed fair value along that curve. That's how you handle monetary policy cycles. You handle them through the better businesses, but what changes, in my point about valuation, what that cycle changes is the perception and pricing of assets. That's why you have to be on top of valuation of your businesses. So we're extremely reactive to the valuations. We've sold out, we've trimmed out of several years. We've been a little bit more active in the last couple of years, which isn't surprising given how markets have done. We found great opportunities to reinvest the capital actually at new attractive businesses. But I think that's the best way you handle that. And the future is largely what's forecasted, most likely that you'll continue to see normalization in interest rate policy. I think the question on Europe, I think to my earlier point to start is I think it'll be very difficult for the whole world to completely decouple from the U.S. So the U.S. is in a rate hike cycle. Absent the volatility in Italy over the last couple of months, Europe was lagging but coming along behind the U.S. England, both the U.K. and Europe were following the U.S. Maybe now that's slightly delayed, I don't know, but at least naturally what has to happen is eventually there has to be some normalization. Now, that's not my prediction that it will impact our investment results, but we just think when you look and approach life, you have to assume what's normal and should happen eventually will happen, and if that does happen, are you positioned okay? And there we run higher quality portfolios where we think we're okay. So U.S. policy will continue. Europe eventually should follow, as with the U.K., as with Japan. Emerging markets already to some degree will follow. What does that mean? Back to valuation. It means risk assets get discounted at higher rates. Equities are long duration assets, thus they're more sensitive to interest rate changes, right? That's how you have to approach it.
Okay. And I think this is another that is very, very close to the one. What your view on dollar?
Look, I think the world is, currencies are a battle of losers, basically now. You know, the dollar's going to strengthen and soften like the euro's going to strengthen and soften because there's no dominant, there's no dominant champion. It's like you showed the boxing at the beginning. Right now, everybody's going to box. Sometimes someone's going to win round one, someone's going to win round two, round three, but I don't see a clear winner right now. The U.S. has its own issues. The U.S. has the U.S. has inflation picking up, a fiscal deficit which is getting bigger, debt load that's increased, right, and is later cycle, okay? So that's its own headwinds. Europe has its own issues, less inflation, more deflation, other political risks on top of it. So everybody's got their own. Japan, you know, no population growth, very, very low inflation, some inflation now. You know, already tight labor market, but with no impact on inflation, largely export-oriented, so they want their currency to be cheap. So everybody's there. So my view on the dollar is just that I don't think you should expect any sort of prolonged trend in any given direction. I think the currencies will continue, to my best estimate, be a battle against each other during certain points in time as the market perception shifts around. But it's very, very hard, as I said, it's a battle sort of losers against each other. You know.
Do you have evaluate any possibility linked to the Italian political risk?
Yeah, we don't. Well, we're the most insulated from it. You know, I guess if there is any insulation, we don't have any. You know, there's some Italian businesses we've owned before, but we don't currently have investments in Italy itself. I think, to your point, though, you know, from a company standpoint, as I said, no. From a portfolio standpoint, less in general too, because even regions that are closer to the Italian issue, we typically don't have as many businesses there relative to other spaces, not because we have a top-down view, just bottom-up. I think we are all actually, though, very exposed to the Italian situation in general. So we do well in down markets, we do better relative, but what's going on in the U.S., what's going on in Europe, what's going on in emerging markets, what's going on in different political cycles, of all those things in the world, I'm more concerned about Europe. Because when I look at all the other problems around the world, from my perception at least, I can see clear solutions. All they take is some political alignment or certain pieces to fall into place, but the solutions are there. In Brazil, they have a fiscal deficit. There's only one way out. Whether you're left or right, they see it. It's just a matter of time. They have to get through election cycle. The U.S. has issues, has a debt issue, an entitlement issue, but it's very doable, very fixable. It's happened before in the past, and it can happen. I'm most concerned of all those things, emerging markets, U.S., about Europe, and about Italy in general for all of our health in the markets, because of what it sort of symbolizes, a more difficult situation with less what would be called sort of market-friendly way out of the problem, which could cause a lot of volatility, right? So at the end of the day, I mean, you know the situation better than me here, but you need some sort of fiscal integration, or you need a currency depreciation. That's the best way to approach a healing of the problem, and those are both very untenable situations under the current construct. So you need, to me, that's why I'm concerned about the Italian risk, because it will affect, I think, risk appetite globally just in what it can symbolize. A difficult situation that can manifest itself over a wider space. It's not just about Italy. Italy's problem is Europe's problem, right? That's not, Italy's problem isn't just Italy's problem. It's Europe's problem, and if it's Europe's problem, it's the world's problem in a way. So, but from the beginning of the question, in terms of direct exposure, no.
Okay. There are a few questions also on the process. What do you mean reasonable price?
Yeah, so we don't have the slide in here, but we do buy great businesses and hold them, but every business we buy, we put a value on the businesses. So we don't just hold something and think it's, we think it's cheap or think it's expensive. We buy a great business, we approximate its current earnings power, what it earns today, so we normalize it if we think it's earning a little bit more, a little bit less than it should on a steady state. We grow that earnings out 5 years into the future at a conservative rate of growth. We put a value on the business 5 years from now, so meaning we put a multiple on it, we capitalize it, and we discount it back to today. And that gives you a simple time value of money calculation. Over a reasonable long holding period for a high quality business, what it'll earn in the future, what's that worth today? We call that our intrinsic value on the business, our approximation of what it's worth, the business. We want to make sure when we buy the business that we think we got the business right, we think we got the growth right. We want to leave some room of being wrong a little bit with those numbers. We don't need to be precisely right, as I said. So we want to discount when we buy a business to what that approximate value of the business is. That leaves us this margin of safety. If a business closes that gap over time, we're forced to sell the business. But this is a key point on that. That discount to what we think the business is worth and what we will pay for it when we buy it, that's not our investment return. And this is a very important concept to walk away understanding, because most people think that way. A business is worth this, you buy it at this, you sell it at that. That's your return. 20% less, 30% less, 40%, whatever the number is, that's your return. That's not how we generate investment returns. We use that discount to give us more conservatism, more forecasting error and being wrong. What we capture in the business is that Essilor slide over time. We want to buy the business undervalued. We actually are fine if it stays undervalued, as long as it stays similarly undervalued. So as the earnings go up over time, the share price will follow that. Hopefully we still contain or maintain a margin of safety, but our return, investment return, is the earnings growth of that business over time. Earnings from 1 to 110, from 110 to 121, and so on and so forth. That drives your investment return at the stock level. A group of those stocks drives your investment return at the portfolio level. So when you look at our portfolio, when you look at the weighted average earnings growth of our businesses we own, that should be our investment return if we own those businesses over time, not the discount that they're at to their fair value. I think it's a very important concept, because most people think in terms of a discount being your return. For us, it's a margin of safety. Our return is the growth of our businesses.
Another point was which are our idea of relationship between governance and rules.
Yeah, so governance and regulation or rules are hand in hand, right? So good governance is handling regulation properly, and bad governance is not appropriately handling regulation. They are, from the question standpoint, if I understand it right, I mean, the two are intertwined. Look, nobody's perfect. We have one portfolio company, Wells Fargo. We've owned it in the US, we've owned it in global, we still own it. We own less of it now as they're going through the trouble that they're going through. What happened, there was a governance issue, right? So, but here's a company with a great long-term history of fantastic governance. There now, in hindsight, was a CEO change a few years ago. And under that whether under that new regime or whether carried over a bit from the previous regime, there wasn't enough governance within the company. I.e., there were some aggressive sales tactics at the branch level. If you haven't read enough about Wells Fargo, it caused that issue in governance, so how you incentivize and manage your employees all the way throughout the organization, caused a regulation problem. And now there's a regulation reaction. Now there's new management, though, coming in to fix that. So the two are intertwined. Sometimes you don't have to get it perfect. What you have to get perfect is the business. So we watch it. We're active around it. We're active in terms of voting, in terms of the board and the board changes at Wells Fargo. So we get involved where we need to be as an owner of the business. But with that, too, it's governance and regulation and what's going on with that. You still got to go back to what you get right about the business and why we still own Wells Fargo despite that. Why? Because it has still a fantastic history through previous managements of great capital allocation decisions. Number one in a bank. Banks make acquisitions historically. Great long-term preservation of that capital for shareholders in terms of the deals they do, the share buybacks they do, how you give the capital back. Number two, they've got a very nice structural mix of earnings. It's not all variable or cyclical earnings, so spread lending income. They have a very nice balance of fee-based visible income plus spread income. So we like the balance of the business being durable over time, although a bank inherently has some cyclicality. And last, they have a very sticky deposit base in the US. So even despite, being in the newspaper and this change they had to have in management and approach to regulation, they still have a very sticky low-cost deposit base because this is a franchise built on a century of delivering and being there. This is a bank that never needed capital in the financial crisis. While every other bank had to go hat in hand, Wells Fargo was forced to take capital just because the Fed forced everybody to take it. They didn't need the capital. They survived the financial crisis without any government help, didn't need government help. So a rock solid balance sheet. So the principles of the business are very strong in there and persistent, but the governance and regulation often can go hand in hand. And I gave you one example where it's not always perfect, but that's where you have to be involved. If there weren't management changes and board changes and governance changes to react to the problems on the regulation side, we would have a problem with the business. But as long as it's still a great business and they're reacting and fixing that, that's acceptable.
Another on the process, that is when you are at the beginning make the stock selection. If you have two similar stocks with the similar expectation, do you use a sort of geographic thinking on that, or? Yeah.
Let me wait a second because I just realized I'll have to translate the question first. So I'm probably 2 questions behind. That's a great question, because this is now how we think, right? So what do we think when we have any 2 stocks, as you said, any 2 stocks together? Because that's what the portfolio is. It's a living, breathing group of companies that have been built on thousands of decisions. Every single stock decision, every single ad trim decision, it's an organic being, the portfolio of living businesses. So we always have this question of the next business, whether we add another business, whether we replace a business. When we have 2, what's better? The number one clear answer to your question is we always look, number one, in terms of what business we want to own incrementally or how much to put in that business versus another one of how strong the business is. So number one, what are the economic returns in the business? Is it a very strong business model? We tend to like less capital-intensive business models. So if we look at the 2 as one less capital intensive than the other, what are the incremental returns on invested capital? What are the margins like in the business? We're always thinking, how predictable is the business? Is one business what it does more predictable than the other business inherently what it does? We always tend to see, as we want to preserve capital, then compound, want to put more money or add more of the businesses that are better. When we talk about these criteria we're talking about, wrapped up in that, is it a better business? Sometimes geographical exposure can have some impact into that. You know, if you have two businesses next to each other, and let's say, for argument's sake, they both had similar high margins, similarly high returns on invested capital, similarly strong number one and number two brands, you know, in good businesses, and one of them versus the other had more exposure to a market, whether developed or emerging for that matter, that had a higher and longer growth potential, then yes, that's where the geography factors in, but it's all a piece of how predictable and how strong the business is and what the growth is.
One was very easy. It was we showed the performance of Unilever, and they're asking if they were expressed in euro or in dollar.
That was dollars.
Dollars, everything is dollar. Okay. Bene, poi sono arrivate anche un paio di domande su...
We had a couple of questions on other boutiques. We're going to ask our other managers to talk about this with you. But let me just take another 2 minutes from the audience to see if there are any questions so that we can involve Matt till the end. No, there are no further questions. Then let me please invite you to lunch. Thank you, Matt.